Earnings season officially kicks off this afternoon with results from Alcoa. My next guest likes to say that he likes the good compared to last year, but he's not impressed. Basically, he says that earnings are going to be good, but revenue is going to be pretty much flat. Right, Howard?
That's correct. We're looking for 31% this quarter, which sounds good, but we're still 11% off the high. Financials would be the easiest example, up 174% this year. But 2 years ago, in 08, they were in the red. They actually lost more in 08 than they're going to make this year. And they're 61% off where they were in 06. So we really need to look at the numbers. They're nice, but you need to do them where we are in the cycle. And more importantly, how they got those numbers. And that's the sales that you mentioned.
Yeah, the sales that I mentioned. And you say that we're hearing conflicting evidence, right, between companies like FedEx that are talking about shipping orders and then what the retailers are saying.
Yes, right. The item on the sales is that, well, we're getting a 31% earnings increase. We're only expecting a 5.5% increase in sales. That's what's going to keep the margins higher. The companies basically are getting there because of the cuts. So everyone's looking towards the sales as well as the guidance from the companies. How are you going to grow the business? You need to grow the business in order to expand, to hire workers, to help the economy. 5.5% is not enough to inspire a lot of companies to build.
But, you know, Howard's bringing up something that we've been talking about endlessly. The bigger question is whether or not there's a new normal in cost cutting. Can companies keep doing this? I mean, retailers are one thing, although Abercrombie & Fitch this morning came out with some strong sales numbers. But what about manufacturers? I mean, can't they get out there and make cost cuts?
Right, and are those jobs coming back anyway after the economy?
Well, there you go, yeah.
The industrials are the ones that we're watching the most, and their sales projections are actually a little bit less than the 5.5, about 5%. That's the places like the Caterpillars and the Deeres that are going to create the jobs, whether they're hiring new employees or hiring back old ones. And that's what we're not seeing the increases in.
Well, to talk again about those kind of companies, though, the industrials and the manufacturing companies, yes, they might be seeing some growth, but it's a theme we've talked about over and over again. All growth outside the U.S., right? I mean, you have a company like GM, for example, who sells now more cars in China than they do here. It's a trend we're even starting to see in the retailers, surprisingly, right?
Well, you were saying that the North American business for some of these retailers are still soft, right?
Yes, the Gap is a perfect example, right? International actually did fairly well, up 3 to 4% for those sales, but the North American business still showing decline. So it's this trend of where is the growth coming from? Still questions around that, but clearly not the U.S.
So given that, then, Howard, you know, after we get through this earnings season, where is the best place to invest?
It's going to depend partially on what's happening in Washington as well as the tax situation. Definitely the growth is more abroad than here, but we need to somehow jumpstart this economy in order to get jobs here. If we don't get jobs in the U.S., the economy is not going to pick up, and more will go abroad than will stay here. So investing is extremely difficult long term until some of those items come into play, until we see what's happening there.
Right, and that's what Alan Greenspan was writing about today, this great anxiety keeping businesses from moving as well as investors. Okay, Howard, thank you for joining us. Howard Silverblatt of Standard & Poor's.